Hello everyone, welcome back to my YouTube channel and I hope all of you are doing great. I'm Ajay and you know me as the average trader, and in today's video we're going to learn about gaps. What are gaps and what are their types and how we can trade them and make money using the gap trading strategies. So before moving forward, I just want to say thank you for all the support you have shown. I've finally crossed 1000 subscribers and I'm expecting more. So please help me in that endeavor and share this video as much as possible. And if you're new here, don't forget to like, subscribe and share and turn on the notification if you want to learn the technical analysis. So let's get started with the video. So first we need to understand what are gaps. So gaps are the areas on the chart. Okay, so what are gaps? So gaps are areas on a chart where the price of a stock or maybe another financial instrument like a currency or a cryptocurrency or maybe commodities move sharply up or down with little or no trading it in between. What I mean by that is just look at this area. Sometimes the price suddenly, suppose a stock is at 100 rupees and next day it opens at 110. So there's a gap of 10 points where there is no trading activity in between. So these are what we call gap, and they are created due to the buying interest that buyers are willing to pay higher price. So there is almost no trading activity in between and the price just suddenly gaps up, and vice versa also the price can suddenly also gap down just like that. So here is a very clean example of a stock named Bharat Gears. A gap was formed few months ago in this stock. As you can see, on this day, it was around, I think so, 18 August. The price closed around 154 rupees, and next day it opened around 168 or 170 rupees. And you can see there's this empty area that is left on the chart where there is no trading activity in between. So this is what we call a gap. So here is another example of 3M India. I'm sure most of you people have heard the name of this company. So as you can see, the gap may sometimes also work as a reversal, right? So I'll tell you what are the kind of gaps later uh, in this video. So as you can see here, the price was coming down here, and suddenly the price on this day around June, on maybe May 30th something, the price closed around 17,900, and suddenly the next day price opens at 19,000. That is a gap of around 11-1200 rupees, and after that you can see the price has moved up to 22,900. So this is how the gap works. The gap is just an empty area in the chart, on chart, where there is no trading activity, and that is created due to the high buying pressure or selling pressure. So what are the type of gaps? There are multiple type of gaps. Gap is not just simply an empty area, it means something, and how you interpret it, that is how we make money. So there are multiple ways and there are multiple types of gap. So first one being the breakaway gap. So it occurs at the end of a price pattern and signal the beginning of a new trend. So uh, what I mean by that it occurs at the end of a price pattern. So it's not necessary that it occurs at the end of a price pattern. You know what are price patterns, like a copper handle, or maybe you know a inverse head and shoulder, or maybe a head and shoulder, or maybe a triangle, the price patterns. And if you don't know, go to the channel. There's a playlist called the Encyclopedia of Chart Patterns where I have explained multiple patterns. You can go through that video. So in case, suppose you know what a chart pattern is. So we know when a chart pattern gives a breakout, right? So sometimes what happen is that the breakout comes with a gap. See, suppose there's a inverse head and shoulder formed here, and the price breaks out, but instead of forming a candle like this, instead of crossing through the resistance area, like this candle here, the price just, you know the price just gaps up and forms a gap and leaves the gap on the chart and opens 20, 30, 40, or whatever the points above the chart pattern area. Or it can also form after a long consolidation where there's not necessary there's a chart pattern, just a simple consolidating a price moving between a support and resistance, just price simply moving within a range, or maybe just small doji candles, some small doji candle formation like volatility contraction, something like that. uh, the if the price breaks away from that consolidation, it can also form a gap, a breakaway gap. That is what we call a breakaway gap, when it breaks away after a consolidation. So patterns are also consolidations. So after it breaks away from a consolidation, it could be a simple consolidation like this between a support and resistance, or it could be a pattern, a cup and handle, or maybe a triangle or something like that. So those are the kind of gaps that we call the breakaway gaps. As the name suggests, breaks away. So it breaks the price away from the consolidation region. Next, we have the exhaustion gap. It occurs at the end of a price pattern and signals a final attempt to hit new highs or lows. So what is an exhaustion gap? So I have this example I showed you here. So this might not be the perfect example. So let me explain what are exhaustion gap. Suppose a price forms a consolidation. The price is just consolidating in a range. It forms a breakaway gap. We know breakaway gap because it comes out of consolidation, and after that the price moves up, or it could also move down if the price signals a breakdown. So it could be either side. The price after a consolidation, the price could go up or could go down. So let us suppose the price goes up after a consolidation. A breakaway gap is formed here, a breakaway gap is formed here, and after that the price started going up, and then another gap was formed. So that is the kind of gap, a continuation gap, that I will explain in just a bit. So bear with me for right now. Another gap is formed. Okay, let me get a clear diagram. So what I said, like the price is just consolidating in a range, and then it breaks away and forms a breakaway gap here. So here is our breakaway gap, and after that the price moves up and forms another gap. So this is what we call a continuation gap, while it is formed in a uptrend or a downtrend. And after that it forms another gap, but this time the price tries to move up, but after few days the price comes down. So that is what we call an exhaustion gap. Like that is the final attempt, the buyers, from the side of the buyers, to take the price higher, but due to the supply, their attempt is failed and the price comes down after a few days. So that is simply what an exhaustion gap is. So then we have the common gaps. Common gaps are, they can be placed within a price pattern. They simply represent an area where the price has gapped. So common gaps could be formed within a consolidation, or maybe about the Nifty open, sometimes gap up, gap down. We call the Nifty open is today opening gap up, gap down. So those are what we call the common gaps that occurs during the consolidation. Simply they occur day to day, or maybe after few days, a very week. So you'll find many common gaps on a chart. I'll show you some examples later in this video. And next one is the continuation gap that I explained, also known as the runaway gaps. We also call them the runaway gaps. This is the popular name, and it occurs in the middle of a price pattern, or maybe a signal a rush of buyers or sellers who share a common belief in the underlying stock future direction. So what I mean by that is, so let me remove all these markings. So I explained you the breakaway gap that is formed after a consolidation. The price is just consolidating in a range, and a great big breakaway gap is formed, and after that price started moving in a single direction. It could be on the upper side or on the lower side. So in this example, let's suppose the price is moving up, and then another gap is formed. Suppose the stock, the first time the stock was at rupees 80, and then it gapped up at 90, and then moved 10 points, around 100 rupees, and then again gaps up and opens at 110 rupees. So here we have 10 rupee gap, here also we have a 10 rupee gap. So this is what a runaway gap is, that is formed during a trend. Okay, so that is formed during a trend, during a sharp move on the upper side or on the low side. There is no consolidation for a runaway gap, or maybe a small consolidation, like 2-3 day consolidation, not a big consolidation. It forms during a trending move. So I hope now you all have understood what are the type of gaps. So let's take a look at the example as well. So these are common gaps, as I said, during the consolidation. They could be formed during the consolidation, right? Every now and then we have a breakaway gap. As you can see here, the prices has been consolidating in this range right here. As you can see, the price has been consolidating in this range, and then we have a breakaway gap, and then the price moves up and it's currently in an uptrend, and then we have a measuring or a runway gap or a continuation gap. So there are multiple names of these gaps. So after the continuation or runaway gap, the next type of gap that we have is the exhaustion gap. As I said, the price has moved up and the buyers try to push the price higher again, but after a few days the price falls down. So this is a bookish representation of what the gaps look like, and I'll show you the real examples as well. So here is an example of a breakaway gap. As you can see, the price has been consolidating in this broad range, as you can see, between 2900 to 2500. So between this around 400 points range, the price has been consolidating again and again, tried to break out, but look at the long wick indicating a false breakout. So after this false breakout here, the price comes down and again started going up and just has been consolidating in this range. This area previously acting as a resistance, as here the due to the supply, the breakout failed. And then after that, here we have a gap and the price opened. Last time the price closed around 2930, and next day it opened above 3000 rupees. And look at the volume combined with the gap, indicating that there's very strong interest from the buyer side, that they are willing to pay the higher price. That is the simple psychology behind a gap. If the gap is occurring on the upside, that is the simple psychology, that the buyers have so much interest in the stock that they are willing to buy it at any price. So that due to which a gap is formed, and look at the candle indicating strong demand, and look how beautifully the price moved up after that, from around 3000 rupees to around 4500. That is easily 1500 points gain. We have another example. I showed you this earlier as well, the Bharat Gears. As you can see here, the price closed around 150 rupees, and the next day it opens around above 166 rupees, around 167. So this is what a breakaway gap looks like, and look how beautifully the stock after that moved, consolidated, and again a breakout, a very strong breakout. Every time during the gap, always focus on the volume. Okay, so that tells you the strength of the buyers or the sellers. So as you can see, look at the volume. Like look at the volume from last 2 3 at least 3 months, and look at the volume at this point. It's 10 20 30 times higher volume. And look at the during the next breakout as well, look at the volume, and after that another breakout that we got here, look at the volume, simply indicating that there's so much demand for the stock. Here is another example of Nelco. As you can see, after a strong up move, look at the volume here, look at the size of the candles. After a strong up move, the price just consolidated for a month from July to August. As you can clearly see, it has been consolidating in a range. This area here, the first candle where after a strong up move, this first retracement candle that we had, and here we have a harami pattern, not a harami pattern, a bearish engulfing, my bad. So here we have a bearish engulfing type of pattern, and this area has been acting as a resistance, and the price has been just consolidating in a range. Then we have a strong breakout, and after that a gap, and look how beautifully after that the stock just shooted up in circuits. Next we have the example of runaway gap. So here first I explained the breakaway gaps which are formed after consolidation, right? So here we have a small breakaway gap, and after that the price is just moving up, and we have a dip here, which we also call as the shakeout, to push the weak hands out. So who are weak hands? Weak hands, the people who have a stop loss, like people like you and me. We are generally known as the weak hands because we have a stop loss, and after that the price moves up, and then we have a runaway gap. Another example of runaway gap, first here we have a breakaway gap, and after that the price is moving up and a gap is formed, and after that here again consolidation breaks out, the price is moving up, and then we have another gap on the chart. The price closed around 930 and opened above 960, so there's a 30-point gap. So before moving forward, a small information about the course. So I have always believed in this philosophy. I read this quote, I don't remember who said it, but I really love this quote and I follow it to the heart. So the quote is like, give a man a fish and he will be hungry again tomorrow. Teach him how to catch a fish and he will be richer all his life. So instead of just, giving someone like, cooked food, just teach them, teach them. Okay, so that is what I believe. This is a quote that I love and thought, why not try to do something similar? So I made this price action trading course for the people who are passionate about trading and stock market and people who specifically love chart. So this course is not a shortcut way to make money, this is just for the beginner. I'd say this is for the beginners, and it is a very good starting point for the beginners who are willing to put their 1000% effort. So this is not a some get rich quick scheme. And here are the topics covered that I've explained in the course. So first we have the risk management, which is the key pillar of being a successful trader or investor. Next we have the basics of technical analysis, types of chart, how to use candlestick patterns the right way, because there's so much misconception about this. People use candlestick patterns in so wrong way, so that I have explained how to use them in the right way. Then we have the trend analysis, Dow theory, stage analysis, chart patterns and how to trade them. Then we have the market breadth analysis, relative strength analysis, how to select stocks and find the next leader, a few trading strategies, pivot point, VCP and all that. Then we again have the emphasis on the risk management and position sizing, all your stop loss placement and all. So these are total 12 parts divided into 14 videos, more than 15 hours of content. The language is English and the price is just 2000 rupees. So if you are new in the market, so this is a really good starting point in my view. You can ask from the people who have bought and they have learned so much from this. And you can find me on Twitter and ask me, or you can just DM me on Twitter and or maybe WhatsApp. I'll leave all the description, how the payment method and all that in description, and you can ask me how to pay and if you have any more doubts and all. So let's continue with the video. So next we have the exhaustion gaps. So gaps that are created at the end of a trend. So simply the gaps that are created after a prolonged uptrend or a downtrend. So after which a consolidation or a reversal occurs. It is indicative of potential trend exhaustion. So as I said, as you can see in this example, a beautiful example, the price has been just moving up from around $45 to it moved up to $80, almost double. And then we had a gap, and again price tried to go up but fell after a few days, and the stock is back to $65. So this is what exhaustion gap is. So these are difficult to identify. Exhaustion gaps are not recognized because they are very similar to runaway gap. You won't know if it is a exhaustion gap or runaway gap until few days. It occurs when the trend is overextended. The main difference between the runaway and the exhaustion gap is that the exhaustion gap is filled within few days. Your runaway gap won't be filled, but your exhaustion gap will be filled after few days. So here are a few examples. So this is a strong uptrend. As you can see, the price moved from $49 to around $55, and then we have a gap and the price started going down and the gap was filled. As you can see here, the wick here comes down to this level and the gap was filled. Again, here we have another example. Here we have a breakaway gap, the price moves up, and then we have, first it looked like a runaway gap, but after that the price suddenly fell and it is back to where it started. So, and the next category of gaps that we have is the common gaps. So these are gaps that occur within the trading range and are not considered significant. They are not significant. As you can see, here's the chart of the Nifty 50 index. As you can see, the price gaps up, or maybe gaps down after a few days, again gaps up, again a gap down, again gap up, gap down. So these are formed during the consolidations or within a pattern, or like commonly these just the price is in a range and these gaps occur after a few days or a few weeks. So another thing that I want to clear first, that is in gap filling, when the price comes back to the, what is gap filling? When the price comes back to the pre-gap level. So suppose a gap was formed at rupees, suppose a gap was formed at rupees 100 and the price opened at 110, but after a few days the price comes back and the price again comes back to 100. So that is what we call the gap is filled. You know, the empty trading area is now filled because the price moved from 110 to 100 again. We call it gap filling. Okay, so sometimes they are filled on the same trading day when there is not much buying interest. You know, you always need a follow through, right? If there is no follow through, then a gap and all that is a waste. So but remember one thing, that not all gaps are filled. This is a misconception that every gap is filled. So I can show you many examples. So this, you can just check the chart of Tata Consultancy Services. So this gap was formed around this 2500 level, and till date this gap is not filled. So like this gap was filled, right? Okay, this gap was filled, but the price came back again, took support at the upper boundary of the gap. You see this region, the price in took support at this region and started moving up. So not all gaps are filled. And how to trade gaps? So now we come to the important part, how to trade gaps. So once you have identified a gap, first thing you need to notice is the volume. So is it combined with a strong high volume which is higher than the last few weeks? As you can clearly see in this example, it is combined. Although the candle here I don't like, but you don't need to go into micro analysis. Just wait for few days, mark the upper and the lower boundary of the gap. See, you see the price gapped up from around 480 rupees to 513 rupees. Just mark this boundary, this empty area, and look at the, and just focus on what the price is doing for next 3-4 days. As you can see here, the price comfortably, it stayed above the gap region here at 513, and after that it broke out. So what you do is, after a few days, 3-4 days, if the price is not moving up, just consolidating, and also the price is not coming down. If the price is not coming down and it is not breaking this you know, this support, that is the upper boundary of the gap, you can just buy and place your stop loss below this level. So that way your risk is very limited. So what you have to do is just mark the boundaries, upper and the lower boundaries of the gap, and what you do is just notice 2-3-4 days what the stock is doing, and you can just enter at that point. If the stock is just consolidating, you can enter at that point and keep the stop loss below. Suppose I bought it at around 530 something, and I can just keep my stop loss below 513, that is at 505 or maybe 510, whatever my rules are, or above the, or I can trail it with, you know, just simple your 10 and 21 day moving average, simple as that. And look how beautifully the price moved up from around 530, if I bought it at 530 to 650, right? And another example of HBL Power, you can clearly see there's a gap formed, and half of the gap was kind of filled, but after that, look what price did after that, just consolidating it in the range and then a breakout. So you can just keep the stop loss below the upper boundary of the gap, or maybe if the gap is small, then you can also keep the stop loss below the lower boundary of the gap. So as here in case of Tata Chemicals, the gap was very big. So what I'll do is just simply this is very strong candle and a very strong volume activity, so all the points are checked. So I'll just keep my stop loss below this 1010 level and just buy it around maybe 1050, 60, whatever price I bought, and you can clearly see the price is still trading above this gap region. So your risk is limited. You can even trail your even shift your stop loss up, that depending on the how the price is moving. So here is another example of Fairchem Organics. So the price was found, you know, this breakaway gap, the price was just consolidating in this range, and the price capped up. So I'll keep my stop loss below this upper boundary of the gap. Just mark the upper and the lower boundary of the gap. So I'll keep my stop loss below this boundary of the gap and just buy it after that if the price is moving up and it is not violating this boundary here. And then just look how beautifully the price moved up again, consolidated, then a breakout. Then I can add more as the volume is also indicating. So this was it for today's video. So one thing, remember, what sometimes what can happen is that the price may come down after 2-3 days. So in that case your stop loss will be hit. So that is not a big deal, because if you're a trader, you're you can only manage the risk. You can never avoid the risk. You can just totally manage it, and this is the best way to manage is because your stop loss is below the gap. And in many cases, if the gap up is strong, if the breakout is strong, the price will never come below the gap boundary, and you can just trail it with the 10-day moving average, 20-day moving average, or whatever your rules are. So that was it for today's video, and I hope you enjoyed it. And if you learned something, do subscribe to my channel, and don't forget to like, subscribe, and share this video as much as possible. And about the course, I'll leave the details in the description and the payment method, and you can DM me on Twitter or WhatsApp to know more details. Goodbye, take care.